Okay, now that you know all about revenues, expenses, and dividends, why are they called temporary accounts and what happens to them at the end of the year? Well, we get to the end of the year and they all dump into this big retained earnings bucket. Which brings us back to what were those retained earnings we learned about? Retained earnings are all the earnings that a company has ever earned over time, minus anything they've paid out as dividends. So a company, when they're looking into this bucket, sees maybe things 10, 20, 100 years worth of business. So that's why we have to keep them in these temporary buckets during the year so that we can analyze the operations of the business on an annual basis. That's great what we did the last 100 years, but how did my manager do managing the business just last year? These temporary buckets allow us to see it temporarily for 1 year at a time. We dump them into the retained earnings bucket at the end of the year. And now I've got empty temporary buckets to start over with on January 1st. And I can also look in this retained earnings bucket and see if there's any cash left that we can pay back as dividends to the owners of the company. So picture the red buckets I've used here and use that to help you remember that the only three temporary accounts we will ever have in accounting are revenues, expenses, and dividends. And the first letter of each of those spells red. And where do those temporary accounts close out to? Into this big red bucket of retained earnings.